Good day. We've got Voxtur Analytics joining us today. Voxtur is a prop tech company focused on transforming and digitizing real estate data and transactions. It's been a very busy year for the company, and it just announced that it divested 100% of the outstanding interest in Voxtur services for consideration of US30 million. And we've got COO Jordan Ross of Voxtur joining us to give us an update and discuss the implications of this transaction. I'm Martin Gago with Market Radius Research. It's Monday, November the 13th. Please remember this is neither recommendation nor investment advice. We're here to learn about the company. Jordan, thank you very much for joining us. What I'm sure you have is a very busy schedule, so I appreciate you making the time. How are things going? And yeah, please give us in the audience an update on what's going on.
Yeah, thanks for having me, Martin. Always good to see you. Good morning, I guess, to you. Good afternoon for those on the East Coast. Yeah, it is. We're pretty excited about what we've been able to do with respect to that divestiture. But before I get a little deeper into that, just level setting for the crowd, for the first time listeners here, or those who have logged in earlier. But yeah, Voxtur Analytics is a fully diversified mortgage tech platform. We're primarily service the US mortgage market with our software, data, and services solutions. So the key to us, though, and what we believe is a big competitive advantage, is the fact that we're independent. We don't have a lending arm. And now, most recently, we no longer have an AMC, so we can really be independent and leverage that aspect for the rest of our valuation technology platforms. Going a little further, though, I think let's get into, I guess, not the elephant in the room, because we disclosed it last on November 1st. But yeah, we sold our appraisal management company, and we did that for a few reasons. And depending on there's a number of ways to look at it. First of all, from a capital markets and a shareholder perspective, we've been listening to our shareholders and wanted to reduce the debt. Not only has the US mortgage market been impacted by the high interest rates, but it's also the corporate debt, which we used and leveraged to grow the company in some of the past acquisitions, right? And so we've seen interest rates more than double. We have a great partner with the Bank of Montreal, long-standing, long relationship, high level, a lot of trust, a lot of partnership there. But at the end of the day, we want to reduce the debt as well, right? We're listening to the shareholders, and so we got to do so. And that was a big driver of the divestiture. So, that comes at a cost, but at the same time, that's going to allow us to be independent, focus on that transition of being a pure play tech company, and ultimately allow and have higher gross profits than previously done. And we believe we did this at no cost to our long-term strategy of being that true tech and data provider to the US mortgage market. So we found a great partner. We were able to do it fairly seamlessly and quickly, right? And ultimately, we actually think they'll be a client of ours going forward, both leveraging using some of our software that Voxtur retained, and ultimately being a referral, since we are no longer in the Voxtur appraisal services business. So it was really a good fit, fairly smooth transaction. There's always ups and downs, but like I practice, never get too high, never get too low. And so we were able to do that and reduce the debt in a real meaningful way.
I find your business, especially as a Canadian, where our property rules and laws and structure is very different than in the US. It's a little confusing, your business. It covers a lot of areas. What exactly did you sell? What services or technologies or what is it that you sold?
Yeah, so what we sold was the services business back in roughly 2008. Where mortgage loan officers were instructing appraisers what the values of homes should be in order to get their bonus, right? In a very high level. And so that created an appraisal management company, which was an independent service offering that lenders would use independently of the appraisers, right? And create that sense of truth. And so that was the business we sold, right?
And it was an actual services business. You did services for other people. It wasn't a technology platform per se. There were people in there have with customers and doing appraisals and managing appraisals?
It was literally a middleman job in terms of we would take orders from lenders and then we would work with independent appraisers to get that value, that appraisal for a home, make sure all the I's were dotted, T's were crossed, and send it back to the lender in order to originate the mortgage. That was the business. It was a bums in seat business, right? So we also reduced our headcount by almost a third. So bringing down the overhead and the expense as well, just generally. And so that was the business we sold. What we retained in that, though, Martin, was that we still have our platforms, right? And so we pride ourselves on having and being able to service our lending clients in a number of ways. We have a platform that allows the lender to control and manage valuations themselves directly, right? Called Appraisal Direct. And we have, a top two mortgage originator in the US using that platform, right? Very, very high margin business. And then ultimately, though, we also have another platform called Voxtur Connect. So in the event that the lender wants to manage multiple appraisal management companies, but while ensuring that they're comparing apples to apples and using the same rules across multiple different vendors, we have that platform as well. But I guess more importantly in our thesis, and you can read about it in the GSEs, the government-sponsored entities being the Fannie Mae's and the Freddie Mac's of the world, they're really, really starting to waive the requirement for an appraisal and use property data collection and automated valuations along with digital floor plans, and collect that data and produce the value. And they believe the collection of that data is ultimately just as or more accurate than the appraiser themselves, primarily due to a number of factors, but human bias, human error, right? And so we were able to retain our property data collection application called Walkthrough. We announced that, I want to say, in mid-August. Super exciting. We became an approved tech vendor by Fannie and Freddie. So they're using that platform, right? And then ultimately our acquisition of a few years ago called Apex, which is the digital floor plan. Technical term is sketch, but in the industry and for us lay people, it's a floor plan. So when you combine the property data collection app that we retained and our floor plan sketching tool under the brand of Apex, it's really, really where the industry's going, right? And so we are, happy to divest of it, reduce debt, but really retain what we believe is critical assets and kind of the use case and the tools that are going to be used going forward.
You sold it for 30 million US. Are you able to put an appraise the value, the cost of it, or what's on the books? Was this sold at a profit, at a loss, or how does that transaction look?
Yeah, it's a great question, actually, and one that we're super happy about. We acquired this business more specifically from Zome, Mr. Cooper, a large mortgage servicer lender in the US, and we acquired it for about $9 million of cash at the end of August 2021. And as you've referenced, we sold it for 30 million cash November 1st. So, there is a great trade aspect to that. We almost 3x the investment. So super, super happy about that as well, right? And sometimes you can't put that in the press releases and put that as forward as you would like, but in this audience, I think it's a point of pride for us.
And again, you're not selling any technology. Your technology platform remains intact. And I guess in a way, was it ever awkward because you were selling the technology to other appraisal management companies, so you were in a sense competing with some of your clients on the services side. So that you're no longer muddying those waters.
Exactly. That became, a great thing for our sales team, right? It became we're truly independent, right? Rather than building and self-serving, right? And so, yeah, that's exactly right. We believe this is going to open the doors for more sales anyway for those platforms, right? Of which, like I said, the acquired Accurate Group, great, super strong management team, well-funded. And we hope they are a client, because it makes it really difficult, and it's really unique for a services company who's valued purely on profits, to invest those profits back in R&D, because it's a bit of a yin and yang. It's taken away from the overall valuation, right? Because you need to take the R&D, or sorry, those profits, and reinvest them in R&D. And so that's where we're allowed to do so. And, it's just, we pride ourselves on our technology acumen, as opposed to being a great service-oriented operator.
Gotcha. I think we've covered the primary aspects regarding that transaction. Is there anything we missed that you want to bring up before we talk about other sides of the business in the market?
No, like I said, it was a great trade. 9 for 30, right? In just about 2 years' time. We didn't give up our core strategy and the vision of being a pure play tech company, right, in the US mortgage market. And so it didn't come at any material cost. And then ultimately, right, again, we listened to our shareholders and made a material dent in our debt with BMO, which was good for everyone, right? Good for us, good for the shareholders, and ultimately BMO was pleased with it as well.
Are you able to discuss, are there potentially any other divestitures you could do going forward to clean up the balance sheet and maybe simplify your own business?
Yeah, for sure. I mean, we've done a valuation, and we're constantly evaluating what we need to do, right? We do have a primary objective of reducing the debt further. How we do that is there's a number of options, and there's a number of ways, right? And I'll give an example. I don't want to be too specific with respect to some of our core non-core assets, but there's a good one. We made an investment in a data management company called Cherry, right? Put $1 million into that. Don't quote me on this, but 4 years ago, well, it's now worth over $4 million, right? And so that thesis and that investment in today's world no longer remains. And so that's another example of where we would like to monetize. When I say monetize our assets, it's not necessarily always going to be a divestiture. It for sure could be, because we believe, some of our assets added up and what their going rate or value would be in the marketplace is much more than what we're trading at today. But at the same time, we got to make sure we're staying true to who we are, and not in terms of our vision of being a pure play tech company, right? And so there is some headwinds that we're experiencing today, but thankfully the Bank of Montreal is working with us and always has.
You spoke of headwinds in the market, the housing, U.S. housing market, the mortgage market, the interest rates, has a lot of activity in that over the last 6, 12 and more months. Can you give us just a high-level overview on what's been going on with volumes? How is that affecting you, and so forth?
Yeah, absolutely. I mean, listen, it's so topical. No, I don't think anybody can either open their screen, or for those who are still reading papers, can't see or are not coming across something about the housing market and mortgage rates. And whether either be it the Bank of Canada or the Feds are going to increase rates, or whether it's a hold. So, I should say there, I get a lot of inbound interest from investors about, what's your forecast? Where can you give guidance? And, I'm not trying to be cheeky, but at the same time, it's like, guys, it's really, really hard. We obviously have a large exposure to the interest rate in terms of US mortgage market. And we believe we're the right solution. But at the same time, it's very difficult. If someone, Martin, if anyone can give us what they think the rates are going to be in 6 months' time, hey, all the power to you. I'd be curious. Maybe you should be doing our jobs in that sense. But it makes it really, really difficult to give that type of guidance. We're always, Gary unfortunately had a death in the family and is unable to be here today, but we're constantly focused in trying to give our investors a sense of transparency as much as possible. But that makes it really hard in the short term, right? We definitely want to give that guidance, but I think until we see some true stability, it's going to be difficult to do. That's number one. But why we, sure, there is a lot of macroeconomic headwinds. I'm not going to dispute that. Why we, feel okay about that though, Martin, is in tough times we're finding, and that's where our clients, being the large mortgage originators, the lenders, they're turning and evaluating, looking to do things more efficiently. Well, by being able to leverage our technology and data, that's exactly the type of solution. So we're seeing a lot of inbound interest for our solutions for exactly that purpose. People need to do more with less. And that's where technology is a great fit, right? Whether it's our Blue Water platform providing a sense of liquidity, right, to those mortgage originators who can't afford to keep the loans, those mortgages on their books, or Voxtur data business, right, where they're looking to evaluate, get more insight, evaluate more risk, and whether a portfolio and or a specific mortgage may have a default event coming up, right? And so that's where I think being a pure play tech company or having software and data solutions is really value add, even though there is, those macroeconomic headwinds in the U.S. mortgage market.
The biggest driver for the volume of your business would be the volume of of real estate transactions. Is that essentially the biggest correlating factor?
Yeah, for sure. But like, just again, to level set, because assuming for those anyway that are on the line that are Canadian, the US mortgage market and the Canadian mortgage market are vastly different, right? And so transactions can mean a number of things. It obviously can mean a purchase, right? And we believe we're moving into a purchase market with people having higher interest rates and needing to sell. So we believe it's going to be a purchase market, early on in 2024, right? The refi market, those who did purchase, say, in the last 6 months at 8%, a percent or two drop makes a reasonable or a rational opportunity for people to refinance, right? Because in the U.S. mortgage market, a typical mortgage term is 30 years, as opposed to Canada, it's 5. So you don't have that enough time to really realize the benefits of a 100 or 200 basis points lower rate. So that's one aspect. But then ultimately, as I alluded to, Blue Water, we have a whole trading platform, right? And that's a lot of transactions where people, for a number of reasons, whether it's a credit call, whether it's a balance sheet issue, whether it's they actually like the negative duration asset being a mortgage, right? A mortgage servicing right. So we are not solely focused in a purchase of a home or an origination or a refinance, right? We have those platforms for that market. We also have our Blue Water platform, which is trading those in the second, what we refer to, or in the US refers to as secondary capital markets. And then ultimately we have a default platform, which has taken some time, to our, unfortunate surprise, that it's taken that time that people are starting to execute. I say people, but lenders execute on those mortgages that are in default, right? And actually taking action. There was a blip there, as we know, in forbearance, right? A moratorium on foreclosures. And then there was, lenders that were working with them to extend the terms and put the principal on the back end of those mortgage terms. But now we're starting to see the lenders start taking action on those mortgages that are in default, that just haven't been able to get out of it.
All right, let's take some questions from the audience here. Are there any near-term catalysts coming that we can expect before the end of the year?
It depends. I can take it in a number of different ways. I mean, we're just trying to execute on the business plan. I'm the catalyst. I'm not sure if there's more detail there, but I think the catalyst is just trying to execute and leverage the Blue Water platform. That trading platform has significantly really high profit margins, and so really being able to focus our attention on that. And I don't know. I apologize for the question. It's a bit of a broad question, but I guess catalysts are, we're focusing on the business, as I alluded to on Blue Water. We're focusing on reducing the debt further in the near term. This isn't a long-term thing or goal. We're trying to do that in the near term. So maybe that would be another thing to throw in as someone's definition of a catalyst. And start the new year right on an EBITDA. We're looking to 2024 to be on an annual basis, be an EBITDA and cash positive basis, right? That's what we're marching towards. That's what we're trying to get the business to doing, right? We've had a couple quarters now of being EBITDA positive, but by reducing the debt further, because that's really just the cash burn on us today, made a big dent, and we look to make more dent in that in our debt to execute on that cash flow positive business.
I guess just trying to guess what the catalyst, I guess there wouldn't be any specific, we shouldn't expect another transactions, a sale of an asset before year end. It could happen, but maybe there's something, it'll be next year, but nothing specifically you hope to announce by year end, let's say.
I'm never going to say no, Martin, but I think it's premature for me to really elaborate any further than I already have on that point.
We understand the buzz around AOL, especially the pushback from the old guard, where their pockets are impacted potentially by Voxtur AOL. How can Voxtur push against this narrative and gain substantial growth adoption?
Yeah, I think
And can you maybe translate a bit of that for the audience so everyone really understands what they're saying?
Yeah, so AOL is it's called an attorney opinion letter, but ultimately what it is it's an alternative to traditional title insurance, right? And I think the person referring to the old guard is the First Americans and the Fidelities of the world, the Old Republic titles. Some of the, it's a multi-billion-dollar industry, very quasi monopolistic, right? And so when we announced this, it ruffled a few feathers, right? What I will say is there's a huge benefit. It's a third of the cost, a third to 50 to 60% savings on the cost to the homeowner, but it provides the same level of protection, and that is really, really critical for everyone to understand. That
can you sort of interrupt an attorney opinion letter? Where is that used in the transaction process? And I guess instead of actually getting a lawyer to sign something, it's more of a digitized, automated process that replaces that, so it can be a third cheaper, or a third the cost. Can you, not too in depth, but just sort of clarify that a bit?
Yeah, for sure. I mean, it's fairly literal in the sense that an attorney is providing an assurance on title, right? Okay. They are signing off on a letter that says that the acquirer has good title. How they are able to do that is leveraging a tech platform with data that they're privy to, right? It also, in the background, still has an insurance policy that sits outside of a lawyer's traditional malpractice insurance, because typically lawyers' professional indemnities have a carve out on title, but we've been able to have a unique insurance policy that covers the professional to do so and gives them the ability to sign off on things. So that's number one. But I think what's imperative, more importantly, Martin, is under previous management, we went out and we were super, super excited, right? The GSEs, the Fannies, the Freddies, they changed their buyer's guide, which sets the rules and allows for the acceptance of an attorney opinion letter, right? With the alternative to traditional title insurance. That was a huge, huge lift, right? And what's different, I would say, under Gary and new management, as we've had some management changes over the last year, is there's been a bit of a shift in strategy. And what I mean by that specifically, as opposed to maybe going it alone versus these large multi-billion-dollar organizations, it's partnering, right? And we're looking to partner with others, right? And leverage some resources. Voxtur doesn't have the balance sheet that a First American does, but we do have partnerships, right? And doing it all together. And that's really the foundation of a good tech company, right? No tech company wants to do it all alone. They look for partners, right? You look at Salesforce, their ecosystem and partners are huge, right? And that's what good tech companies do. So we're looking to partner with others, right? Not be and leverage multiple resources rather than trying to go it alone, because we just don't have the resources to do it. And it's tough to do against the old guard as the person asking the question, right? And so we've shifted the strategy a little bit, and are going it that way, right? Which will allow for less resources and less of less confrontation, I guess, is maybe the best way to describe the updated strategy. Being a little less confrontational and in your face with the old guard. So doing, again, I guess doing a little more with less, right? and trying to span your wings with others rather than just doing it ourselves.
If you would do a partnership with one of these old guards or with whoever, would items like that get news released, or is that just normal course of business and you can't maybe necessarily release the name of the company? Because you've got a lot going on. You don't issue a lot of news releases, which I can understand why it's just difficult in your business to do that. But I guess investors don't see you're like an iceberg. There's so much under the water that we don't see. It's hard to get a sense of what's going on.
Yeah, for sure. I mean, our industry is not known for news releases, or no lenders. They all have very, very difficult times putting things out there, being the first to do things, right? Nor do they want to give up a competitive advantage by using a unique or new technology like we have. That being said, for sure, I think something like that would be news released in the event we would partner with one of them, and there definitely has been interest, right? But getting their heads around it, it's a bit like one of the taxi companies acquiring Uber, right? It would be, I mean, that's a dramatic example, but for everyone to really understand it, that's kind of the situation we're in, right? This is a new way, more efficient way, more economical way of doing things, right? Yeah. And still gets you from A to Z. But it takes time, right? And there's a big budget. Unfortunately, we didn't have the bank account or the balance sheet that Uber had from their investors leverage. So we're trying to do as much as we can with the resources we have, while trying to march towards becoming a EBITDA cash flow positive company, right, under the new world, right? And so times have changed, and that's really where we're at with AOL.
Yeah, I would think it's sort of that innovator's dilemma. Do the big old guard change their whole business model? It's profitable now. Are they the first to do it, or do they just milk their cow longer until they're kind of forced to do it? So they've got some strategic pondering to do.
That's exactly right. And time will play out. What I can say, though, is we are in conversations with a good chunk of them. Right. And so, it's real interesting times right now, specifically around AOL.
Interesting. All right. How much of the sale of Voxtur AMC is used to pay down the debt?
Yeah, we didn't disclose that, so I want to be on side. But all I can say is there's a real material amount. I feel, I don't know if I'm going to want to come. We may, in our earnings call, which is, at the end of the month, we may choose to give a little bit more clarity, but at this point in time, we didn't disclose it then. And so don't really want to give a specific number now, but what I can say, it is a material amount.
And it just strengthens, throwing 30 million US on your balance sheet. It just strengthens that up clearly a whole lot. How will you get rid of the balance of your debt? Or do you want to get rid of it? Or is there a certain level you'd happily operate with?
Yeah, I think we need to do more for sure. Ideally, we get rid of it altogether, right? But that also comes at a cost, right? So we don't want to give up. We don't want to reduce the debt to the extent and at the price of our strategy, right? That being said, we think we need to do more. We definitely need to reduce more, but how low? I don't know. Ideally, we get rid of it altogether. Absolutely. But I think, somewhere in the single digits, we would feel comfortable with. I think the Bank of Montreal would definitely feel comfortable with as well. And I think that's up in the air, but in the single digits, we would be comfortable with, but that doesn't mean we wouldn't reduce it altogether.
And it depends as well on how profitable you can make things in the short term or next year. If you get to the point where you're generating tons of cash flow, then the debt makes a whole lot of sense.
Right. All of a sudden, exactly right. It's a catch-22, right? As our cash flow starts becoming positive, is there really a need to reduce the debt further? And that would be an evaluation internally that we'll have to do. But, we're not there yet. We will be reducing it further. That I can say.
Are there any immediate plans to consolidate or reverse split the outstanding shares?
For sure. I mean, it's always, capital markets. I put that in our capital market strategy, right? And right now, at the sole focus is making sure we are efficient, getting the company back to an EBITDA positive and a cash flow positive company, right? And a big requirement in that is just reducing the debt further. So that's what we're focused on. That being said, we're also looking at listing to a big board, right? Moving up a big board. So reducing the debt and uplisting, right, are all catalysts potentially to consolidate and clean up the cap table. What I can say is it's not lost on us that we need to do that. It's the timing that when we do that is imperative, right? I don't have that timing today because I want to do it at the right time. You only get that chance and that opportunity once, right? And you want to make sure you're doing it at a time where you're on the up and up, and not just what we've seen others do as a last ditch effort to try and raise the stock. That's not the right way to do it. And so we want to do it at a time when we're on the up and up, which could be reducing the debt further, uplisting to a big board, gaining new investors, right? It's those types of things that I foresee that coming. So I'm hesitant to give it a timeline, but I definitely see that coming, ideally in the first half of next year.
Gotcha. And it always makes sense to me to, when you're doing a consolidation or anything, to do it with other actions, not just on its own. It's part of a more of a bigger strategy. So
100%. That is not lost on us. We are not going to panic and just hit that button just because, we know we need to. We want to do it at the right time, right? And ultimately, that's, the shareholders have everything to benefit from that, right?
All right. Jordan, you talked about 5 large conduit clients early in the year. Have they been onboarded, and are they generating revenue from those clients?
Yeah. So the answer is yes. Generally, I want to say there's 3 of them that have gone live and generating today. I think a couple of them, because a conduit, just the level set here for yourself, Martin, and the audience, some of the audience, first-time listeners, is a conduit, or what we refer to a conduit, is connecting sellers. So those local, being credit union, regional banks, local banks, local or smaller mortgage originators with the large mortgage aggregators, either hedge funds or larger lenders, right? That has the balance sheet to keep those loans and want to acquire more mortgage servicing rights, right? So the answer, it's twofold, right? We have the platform that's built. That's the beauty of Blue Water. That's the beauty of a marketplace. That's why we have the ability to have such high profit margins, because the R&D and the platform's built. Now, I'm being a little cheeky there because there's constant updates taking place. But ultimately, what the next step is signing up those sellers, right? Those local mortgage originators, on the heels of having buyers, right? To buy that product from them, right? And connecting both parties. And so that takes some time. Some banks are quicker than others to do so. It's all, right, the appetite for risk and how quickly they can move. And unfortunately, we're always at their mercy, right? Who reviews contracts, who has a vendor program, who has better legal counsel or in-house counsel, right? And so we're at the mercy of them. But yeah, we're up and running definitely with 3 of them. And so, we're pretty excited about that. Again, they're trying to figure out, and pricing is always an issue, right? Somebody's about to acquire an 8% mortgage potentially, but then, how do you price in the risk of the mortgage rates going down to 6%? And that mortgage and that borrower refinances their mortgage and potentially lose that mortgage, right, to another bank that's offering 6%, right? And so, it's difficult at the moment with these high interest rates to price things. But the answer is yes, they are up and running. We are earning revenue, not as much as we would like, right, due to the volatility and a bit of the uncertainty with the rates going on today. But they are up and running.
You talked about, you had a goal, I believe, of being cash flow positive or EBITDA positive in 2024. There's a question here. When will you be cash flow positive? Still estimating Q4, or did you mean 2024?
I think I meant 2024 for sure. I mean, the goal is, the marching orders from Gary on down is definitely to reduce that debt further. And when we're able to do that, that cash flow will become positive, right? Every business is positive on its own. It's some of the public company costs and the corporate debt costs that are kind of hurting the cash flow at the moment. Why I continue to reference bringing down the debt further.
Can you talk about how Voxtur charges for the B Water, I presume Blue Water platform usage? Is it based on a flat fee or transaction? Is it kind of like a brokerage, like a stock brokerage house where you clip a little bit per transaction?
Yeah, it is transaction based. But there's a couple different things. Well, there's multiple different things that Blue Water does, but we'll talk about the trading, which is their primary source of revenue, right? And there's two types of trades. There's the big block trade, which has multiple mortgage portfolios, right? And then there's the conduits, right? And that's why Al Qureshi and team are focusing on the conduits, because that's a flow. So as the mortgage gets originated, it flows right through the conduit, right? Which allows for more recurring, stabilized revenues, as opposed to these large bulk trades, which has multiple mortgages contained in them. So those are a little more ebbs and flows, although when they hit and they're great, high profits, but it's a little more choppy, right? And it takes a little longer to do. And that's why Al and team have always focused on the conduits and building these conduits, because it's a steady flow. Coming back to the person's question, though, it is based on transactions, right? And we get paid a fee to do, depending on the buyer, whether they pay us to do the due diligence on them, or is it simply brokering the transaction on our platform, right?
What sort of take up on volumes are you seeing from the Cap Trader platform that was set up for the mortgage collaborator?
Yeah, so that's Blue Water again. That's our trading platform, right? And so we're seeing, and the mortgage collaborative was a form of, again, do not quote me on this off the top of my head. It's a few hundred local mortgage originators, right? So small mortgage originators that what Blue Water does they're a collaborative, as the name alludes to, provides liquidity to them, right? Which they didn't typically have, because traditionally they would have to call up a consultant to value their portfolio and then ultimately find a broker to broker to send to sell the portfolio to, right? And then have a third party do some of the due diligence. Whereas Blue Water, they sync up to our Blue Water platform and it does the due diligence for them. It prices their portfolio or their loans for them in real time, and allows them and gives them access to a buyer right away, right? And so, yeah, it's an important initiative for sure. It's still early days. But we're seeing signs of success from that, right? And it's been a decent partnership to have.
We have to start wrapping things up here, and we've got one last question for you. It's regarding insiders buying. Can you comment on the blackout period where the company insiders might buy additional shares? Presumably, with your earnings coming out, you're blacked out right now, but I guess in December you'd be potentially available for that.
Yeah, exactly. So I've been here for almost 6 years, I guess, and it seems like the blackout period is constant. So yes, there's going to be a small window, I guess, roughly right from the end of November to the beginning of January, that there will be an opening there. I can tell you the pressures, the only sales that we've had or that have been required is purely for tax purposes, right? And so when because the company has a requirement and fiduciary duty to submit taxes on behalf of by the end of December, right? And so that's been the primary reason for any insider sales. I don't know of any off the top of my head, any material amounts recently, right? And so, yeah, I think internally it's definitely, we love the business, right? We like where we're going. It's been set on tough times from in a pure capital markets analysis. It's small cap's been hit hard, technology's been hit even harder, and then when you layer on serving the U.S. mortgage market, it's been a bit of a trifecta, and I think that's been the primary reason for the pressure on the stock. But we would like to think that with some of the strategic moves we're doing by reducing the debt, which some, I guess, see as an overhang on the stock, we're trying to do that. We're trying to march towards being an EBITDA and cash flow positive business, which I think is a differentiator in the small cap world, right? And then ultimately, by doing those two things, we're starting to see new investors come into the story, which ultimately drives up the stock, right? And so, yeah, it hasn't been easy for sure, Martin. I'd be lying if I said it was, but at the end of the day, and I speak, what Gary preaches is continue to do the right thing, focus on the business, and the markets will take care of itself, right? Gary and I have been a little bit shy on the marketing front. We love doing things like this, but we've been a little bit shy because the business is changing, right? And we want to go back to the market, not saying, hey, we're doing this, this, and this. We want to say, hey, look, this is where we're at. This is no change to the business. The business doesn't need any change, and look what we're doing, right? And so, yeah, I would say in the last few months we've been a little bit shy to do some of the marketing, but always happy to do so. Always happy to take investors' questions. But I think 2024 is going to be a really big year due to some of the things we've done, not less about 13 days ago, and hope to have maybe announced prior to the end of the year. I think it will give the investor base and new investors a real sense of where we're at and where we're going.
Well, and just one other thing to layer on your trifecta is the quadfecta or whatever, is we're in tax loss selling season as well. And after a couple brutal years, it's just one more thing piling on small stocks.
Yeah,
so
I think we're, for sure, it's tax sell-off. Listen, in my own personal account, I take that, and I am nervous about that. But I don't think we have that. I'm hoping we don't have that. I think that really hurt us last year, just due to where we were at. We were an $800 million market cap. We were $1.75 April 2022. I don't think we're going to see that this year. I think people's resonate. I think it's actually probably a great buying opportunity. Sure, I'm biased, but I really do. I can't foresee this going any lower because we're doing all the right things, right? We're doing what our shareholders are asking us, reducing debt, being cash flow EBITDA, and marching towards being a cash flow EBITDA positive company, right? And so I think it's a great buying opportunity. 2024, with the relaxation on the headwinds, right, and the fundamentals within our business and the financials, I think it should be a great buying opportunity for us. But it's definitely front and center for sure.
Jordan, with that, we need to wrap it up here. Thank you very much for your time. We appreciate that. All the best, and looking forward to chatting with you again in the future and getting another update when it makes sense. Cheers.
Absolutely. Thanks for having me, Martin, and I appreciate everybody listening in.